Good day everyone. Today's lesson, I would like to explain to you about balance sheet, statement of retained earnings, and income statement. What is a balance sheet? The balance sheet, along with the income statement and cash flow statement, is one of the three main financial statements. While income and cash flow statements show your company's activity over time, a balance sheet provides a snapshot of your financials at a specific point in time. It includes every journal entry since your company's inception. It shows what your company owns, assets, what it owes, liabilities, and how much money is left over for the owner's equity. It summarizes a company's finances and is also known as the statement of financial position. Why it is called balance sheet? Because the asset section will always balance with the liabilities and owner's equity sections. The purpose of a balance sheet to a business are: The purpose of a balance sheet to a business are: 1. Inventors and lenders require them. For example, if people give your business money and want to know exactly what they're getting into, the balance sheet is the last way for them to see the big financial picture. So if you want to raise any capital, you need a balance sheet. 2. It shows you the layer underneath income and expenses. If how much money you earn and spend isn't all there is to your business. Do you have any loans? Have you bought any equipment, etc.? You may be making way more than you spend each month, and that's a great way to start having a healthy business. But without understanding the assets and liabilities that lie underneath that monthly revenue, you don't really know how much your business is worth. 3. It shows you just valuable your business is. Maybe your business is not bringing in as much net income as you hope it will and you are discouraged at your financial prospects, or sometimes that doesn't tell the whole picture, so the balance sheet reminds you of all the assets you've invested in the past and how much those are worth to you. What goes on a balance sheet? At a high level, a balance sheet works the same way across all business types. They are organized into three categories: assets, liabilities, and owner's equity. Assets are the things your business owns. List your assets in order of liquidity, or how easily they can be turned into cash, sold or consumed. Bank accounts and other cash accounts should come first, followed by fixed assets or tangible assets like buildings or equipment with a useful life longer than a year. Even intangible assets, hinihinahahiwakan, like intellectual properties, trademarks, and copyrights should be included. Current assets is anything you expect to convert into cash within a year. It include here the money in a checking account, money in transit, money being transferred from another account, accounts receivable, money owed to you by customers, short-term investments, inventory, prepaid expenses, cash equivalents, currency, stocks, and bonds. Non-current assets or long-term assets, on the other hand, these are things you don't plan to convert into cash within a year. Long-term assets include buildings and land, machinery and equipment, less accumulated depreciation, intangible assets like patents, trademarks, copyrights, and goodwill. You would list the market value of what fair price a buyer might purchase for these long-term investments. Let's say you own a business called Company ABC. As of December 31st, your company assets are money in a checking account, an unpaid invoice or any equipment worth $900. Here's how you'd list your assets on your balance sheet. The formula here is total asset equals current asset plus non-current asset. Next is the liabilities. These are the business's financial obligations and debts. These are the list liabilities by their due date. Just like assets, you'll classify them as current liabilities, due within a year, and non-current liabilities, the due date is more than a year away. These are also known as short-term liabilities and long-term liabilities. Current liabilities might include accounts payable, what you owe suppliers for items you bought on credit, wages you owe to employees for hours they've already worked, loans that you have to pay back within a year, taxes owed, credit card debt. Non-current liabilities, loans that you don't have to pay back within a year, bonds your company has issued. Returning to Company ABC, let's say you haven't yet paid the latest invoice from your supplier. You also have a business loan, which isn't due for another 18 months. Here is the example of liabilities. Equity is money currently held by the company. This category is usually called owner's equity for sole proprietorships and stockholders' equity or shareholders' equity for corporations. It shows what belongs to the business owners and the book value of their investments, like common stock, preferred stock, or bonds. Owner's equity includes capital, the amount of money invested into the business by the owners, private or public stock. Retained earnings, all your revenue minus all your expenses and distribution since launch. Equity can also drop when an owner draws money out of the company to pay themselves, or when a corporation issues dividends to shareholders. In Company ABC, let's say you invested $2,500 to launch the business last year, and another $2,500 this year. You've also taken $9,000 out of the business to pay yourself and you've left some profit in the bank. Here's a summary of Company ABC equity. Out of the business to pay yourself and you've left some profit in the bank. The income statement is a financial statement that shows how profitable a business is, showing the revenue, minus expenses and losses, and is one of the three most important financial statements in financial accounting. Small businesses typically produce it when a bank or investor wants to review the financial performance of their business. Here's an example of income statement. For a small business, income statements are designed to be read top to bottom, and starting from the top is the revenue. 1. Sales revenue. Ito ay kita ng isang organization o ang paranadinala ng isang negosyo sa loob ng isang tiyak na galang panahonan. To calculate this figure will depend on whether or not you do cash and how your company recognizes revenue, especially if you're just calculating revenue for a single month. In this figure will simply represent the total revenue for whatever time period the income statement is covering. In this case, the time period is the year ending on December 31, 2021. 2. Cost of goods sold or COGS. This is how much it costs to produce all of the goods or services that already sold to the customers. If the company is a service business, this line item can also be called cost of sales. Ang COGS ay nasasangkot lamang ng direct ang gastos tulad ng raw materials, gastusin sa paggawa at maaaring sa pagpapadala ng products. Katulad na lamang ng ABC company na nasa example, kabilang dito ang gastusin ng kampanya sa raw materials, sod, packaging at iba. Indirect expenses like utilities, bank fees, and rent are not included in COGS. We put those in a separate category. Point 3. Gross profit, after taking into account direct expenditures, but before taking into account overhead costs, the gross profit will tell you how profitable your company is. It's a rough indicator of how effective your company is. The gross profit figures can rise even when a company's gross profit margins fall, indicating a drop in profitability. 4. General expenses. Sometimes referred to as operating expenses, these include rent, bank and ATM fee expenses, equipment expenses, marketing and advertising expenses, merchant fees, and any other expenses you need to make to keep your business going. These expenses are listed individually here, but some income statements will bundle these and other similar expenses together into one broad category called selling, general and administrative expenses, SG&A. If an expense is unrelated to core business activities, it's known as a non-operating expense. 5. Operating earnings. This represents your company's profit before adjusting for external costs like loan interest and taxes, which you have less control over, and after deducting all internal expenditures, which you have greater control over. This is what accountants refer to as operating profit or operating income. 6. Interest expense. Kung ang isang negosyo ay may utang na para sa isang tao, ito ay kailangang magbayad ng monthly interest. And the interest expenses are the total interest payments on that business made to its creditors for the period covered by the income statement. 7. Earnings before income tax. Earnings before tax, EBT, is a calculation of a firm's earnings before taxes are deducted. It is calculated by subtracting all expenses excluding taxes from revenue and can be found in a company's income statement. EBT is an important figure because it removes the effects of taxes when comparing businesses and can reflect a firm's performance when compared with industry peers. This is how the business's profitability before it pays its taxes. 8. Income tax expense: the total amount of taxes owed to a taxing authority by an individual, corporation, or other entity is referred to as income tax expense, and is calculated by multiplying taxable income by the effective tax rate. Other taxes, such as property or estate taxes, may be imposed on the value of an asset. This is how much you paid for the tax expenses. And 9. Net profit, and at the bottom line, from net profit, also called net sales or net earnings, is the total profit for the business. Net profit is the amount of money left over after all expenses have been paid. Consider net profit to be your paycheck. It is the money left over after all taxes and benefits are deducted. I'll end my lecture here, and I hope I've imparted some knowledge to you today. Please don't forget to like, heart, share and leave your comments. Thank you so much. And God bless.